Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, September 15th, 2023. Yesterday, the S&P 500 index closed at precisely the same level it did on July 14th. Last week, I singled out oil prices and interest rates as the two macroeconomic factors behind the stock market's inability to move higher over the past 2 months. Both of those metrics moved higher this week, making it difficult for the equity markets to gain new ground. Now, here's a chart of the S&P 500 year to date, and you can see it peaking back here at the last day of July, and since then hasn't been able to get back up there. Meanwhile, crude oil prices have risen pretty dramatically since third week of August, when a barrel of crude oil was below $80, and now it's got back up over 90. At the same time, Treasury yield curve is not quite as high as it was a month ago, but still ticked up here in the last week. That's okay. We don't need the stock market to move higher right now, although that would be nice. We just needed to hold on to the gains made over the first half of this year until the Fed is done raising interest rates. Next week, the Fed will most likely raise rates again based on this week's Consumer Price Index report for August. Those numbers came in a little hotter than expected, including a 0.3% monthly rise in core CPI, which excludes food and energy, and a 4.3% increase over the past 12 months. So if you come down here to the middle of these list, where it says all items less food and energy, and you come across, second to last column is the month-over-month rise in August of 0.3%. The last column is the unadjusted 12-month year-over-year rise of 4.3%. However, when food and energy are included, headline CPI jumped 0.6% last month, which is its largest monthly increase this year. And here you can see at the top where it says all items, that's also known as headline CPI. Excuse me, again, go out to the second to last column for August, and you see a 0.6% month-over-month rise in headline CPI. The culprit was energy prices, which jumped 5.6% in August, due primarily to higher gasoline prices. And down here, if you look at the energy prices, and again, gasoline, all types, you come out here, gasoline prices jumped 10.6% in August alone. So there's the culprit. Food prices rose only 0.2% last month, which was less than the core CPI rate. And here's, where's food? Right here. You can see come out again to the second last column, 0.2%. So it wasn't food, it was energy that was the reason for the bigger than expected jump in CPI. As I mentioned on page 2 of the new issue of Personal Finance, Fed Chair Jerome Powell has not altered his attitude towards monetary policy despite a big drop in CPI during the past year. However, he has been more circumspect in how he articulates that policy, which has been misconstrued by some Wall Street analysts as proof that he is softening his stance towards inflation. We'll find out next week how Powell is feeling about inflation. On September 20th, Powell will announce what, if any, changes to monetary policy the Fed will make this month. In light of this week's CPI report, my guess is he'll raise rates by 25 basis points. That's what the bond market seems to think too. This morning, all maturities along the U.S. Treasury yield ticked higher, with the 6-month T-bill offering the highest yield at 5.5%. Now here's CNBC.com bond market, and if you look, they've got maturities ranging from 1 month to 30 years, and right here in the middle, you can see 6-month Treasury bill at 5.53. So that's where the yield tops out. The curve tops out. If bond traders believed Powell will not raise interest rates next week, I'd expect to see bond yields to come down a bit on the expectation that the next rate change will be a cut. Now, speaking of the new issue of Personal Finance, you'll notice it has been reduced from 16 pages to 12. Yes, inflation is affecting us, just as is everyone else, and we want to continue providing the service at a reasonable cost. We have eliminated the growth and income roundup since those articles are readily available on the PF website, along with the Q&A section that a recent survey indicated was of little interest to many readers. Of course, we encourage all PF subscribers to visit the website for the most current information. As always, you can ask any questions you may have in the Stock Talk feature beneath this and all other articles that appear on the site. That's this week's PF video update, and I look forward to talking to you next week. Thank you.